Well, hello and welcome to this live stream on the 21st of October 2025. Martin North here from Digital Finance Analytics. Great to have you on the show this evening, and thanks for taking some of your Tuesday evening out to spend it with me and Adam. It's really appreciated. Going to have a really interesting conversation today, and there's so much to talk about, of course, with a lot of the noise over the last few days with regard to crypto. I want to strip out the noise from reality, and also, very importantly, I think, dive into stablecoins and what's going on there, because there are some really, really important developments which many people have not got their heads around yet. So we're going to explore that too. Before I bring Adam in, I'll just remind you we're not providing specific financial or legal advice. It's a general conversation only. We moderate the chat, but feel free to throw your questions and comments in as we go. And as appropriate, I will bring them in. And also, if you'd like to get my attention, if you use that Walk the World, that'll mean that your question gets to my queue. Or indeed, if you want to make a contribution to what we do around here or get your question to the top of the list, I've enabled Super Chat, and you can use that to get your question to the top of the list, or indeed, more broadly, make a contribution to what we do around here. Really appreciate those who support us, whether it's via Patreon, whether it's via the PayPal, or by the Super Chat. It all helps just to cover the costs. I don't do this for profit. I do this because there's a really important conversation to be had, particularly now, particularly with some of the generic global uncertainties, the political uncertainties, the economic uncertainties. And I think that it's really important that we help people to be informed about what's going on. Right, let me bring Adam straight in and we can get going. Adam, welcome back. Lovely to have you on the show again. Thank you for coming over.
Great to see you, Martin. Happy Tuesday.
Yeah, indeed. Tuesdays is my night, as you know, and great to have you on this evening. So let me sort of bowl the question straight at you, right? Because there was a lot of noise over the crypto story over the last few days, and people saying, oh, this is the end of crypto, et cetera, et cetera. And in fact, my headline for this show was what the F is happening in crypto, right? Because I got confused insofar that I don't see it the same way as some of those doomsters were. There is a volatility to crypto, right? We know that. Volatility has been up and down. And here's a bit of data that shows that if you look at major corrections from all-time highs from September 2010 to date, it happens. It happens relatively frequently, but then it comes back. So tell me, my friend, what is really going on in crypto? Is this the end of the world, or is it actually just another little blip along the road?
First of all, well done for a very balanced and fair opening to what's happening in crypto. Second of all, no one knows. Third of all, I look at the data and I look at the facts. So let's get into that. Why it's different this time, Martin, it's very different this time for many reasons. First of all, what typically happens in a 4-year cycle, particularly where we are now, we have the halving, which was a while ago, and then you have the all-time high. What actually happened this time was that we had the all-time high for Bitcoin before the halving, so that was different. What was also different was that we had the US government backing crypto to the extent that they weren't SEC angry against crypto, but they were SEC friendly towards crypto. That's never happened. The next thing is that we've never had spot-backed Bitcoin ETFs or ETH ETFs in the United States. That's different. Then we can see the mining power is getting bigger and bigger, and there's more exposure to crypto from institutions. That's never happened. We have other federal governments, if you look at El Salvador, Bhutan, and other nations adopting this technology. That's never happened. So many people say, you shouldn't say this time is different, when in reality, many things are different. Now we go on to patterns that we've seen before. What's also different this time, before I go on to what's happening with gold and the M2 money supply and the interest rates, what's different this time is typically we have a thing called Rectember, where September is a terrible month, and October we call Uptober or Rocktober, where it's a brilliant month. Well, looking at September, it wasn't that bad. We actually finished the month higher than where we started. So that wasn't too bad. So it wasn't really a Rectember. Then we go into October, where it's typically time to go to the moon, and we can see that we've pulled back. Now, some people have said, well, it's the end of the world, but we've seen this volatility before. Now we go on to what is similar, what the patterns do normally play out. We can see there is a very strong correlation when gold hits an all-time high. In Bitcoin, we get very excited about that. The Peter Schiffs and the gold buffs go, ha, we told you. And we're like, no, 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 you've just paved the way for us, because we can see over and over again that when gold hits an all-time high, Bitcoin is next. And that's why we're very excited about that. The next thing we can see is that when the M2 increases, when the money supply, essentially the money printers go on, risk on assets, particularly Bitcoin, which is now moving from a risk on asset to becoming less of a risk on asset, that pumps. Then we can also see when interest rates drop, it causes Bitcoin to pump. So we've got this very weird dynamic where so many things are different but the same in the sense that Bitcoin is continuing to go up and to the right. The market cap is hitting all-time records, not just in Bitcoin, but across the entire crypto landscape. Bitcoin ETFs have never had so much institutional investment. BlackRock is making more money, has made more money as a ratio or in a matter of time from Bitcoin ETFs than any of their other ETF products. So the big boys are saying, well, hang on, this product looks really attractive and we're making a lot of money out of it. Now, whether it's for the vibe and support of what Bitcoin stands for, or simply to make money, I think it's to be the latter, not the former. But in any case, we can see that everything is primed for Bitcoin to go ballistic. Gold has paved the way for us. The money printers are on. The interest rates are about to drop. And we've got this flush out in the markets. Now, you may have heard about a week ago, a bit over a week ago, we had the biggest liquidation event in crypto's history. I point out it wasn't the biggest price drop in Bitcoin. We'll stick with Bitcoin for now. It wasn't the biggest price drop in Bitcoin history. It was most certainly the biggest liquidation event in Bitcoin's history. Nearly 90, it depends what data sets you look at, but around $19 billion washed out in long positions. The market was too frothy. People were too excited. There was too much leverage. People were getting too greedy. And whatever happened, whether it was malpractice or just the markets doing what markets do, or whether it was Trump's son or Binance or the Russians or the Chinese, what happened in the end was billions upon billions of dollars of long positions were washed out of the markets. That pulled back and the market basically reset. The market then rallied up again. People tried to revenge trade and buy their way back into all of their losses. And then the market pulled back again. Now, of course, this is exactly what you said, Martin. Crypto is volatile, but as an aggregate, it continues to grow in so many metrics. I also point out that the mining strength of Bitcoin, the network security, has never been this high. So it continues to grow. It continues to get so much more strength. The volatility, although this volatility, it might be alarming to many people. Man, I've been in here since 2016. This is nothing compared to 2016. 2016, it was wild. A 10% pullback for us, even a 20% pullback for us in crypto, is nothing like it was back in 2016. Now, in traditional markets, when you see a market cap of $2 trillion pull back 10 or 20%, it's the end of the world, because in the old paradigm, that type of volatility was something that the market couldn't bear or the market couldn't stomach. For crypto veterans and those who have been here for a long time, it's just another day in crypto. And by the way, it's nowhere near as bad as it used to be. What we can also see is, as I mentioned, with those billions of dollars washed out in those long positions, the percentage drop in the price of Bitcoin was nowhere near that we've seen before. That is, we've seen 50% wiped off Bitcoin in years gone past in a matter of days. That wasn't the case this time. Depends what data set you're looking at. You're looking at around 120 down to 104 or $102,000 within a day. And again, to the normies, that's like, oh my God, how could this happen? But for us, we remind everyone, volatility does not discriminate. Volatility, we are told in the media or to those who are new to it, they think volatility means just going down. It's going to drop very violently. No, volatility is blind to direction. Just as we've had a $10,000 drawdown in a day on the price of Bitcoin, we can easily do that, double that, quite easily do that in a day the other way, going up. So I gave a prediction a while ago, Martin, that we'd see a $10,000 pump in Bitcoin in a week. And that happened. It happened in about 3 or 4 days. I give the prediction now, and this is just my opinion, my prediction, that this bull run is not over. We are primed to go ballistic. Now, again, I'm just one person and this is my prediction, and you're going to hear 20 people who support me and 20 people who disagree with me and 20 people who are neutral and too scared to make a decision. But my prediction, my experiencing, my experience and my forecasting says this is simply crypto doing what crypto does. And noting the M2 money supply is going through the roof, gold has hit an all-time high, silver's hit an all-time high, the dollar's in a lot of trouble. The BRICS nations are moving to get gold-backed currencies, and Bitcoin is, the US is looking at, at least backing their currency with, or their perception of backing their currency with either gold or Bitcoin or something that is scarce beyond printing money out of thin air. I still stand by that Bitcoin and crypto at large is going to do a very big run by the end of the year. Many are also say that the 4 year cycle that we've been used to is a thing of the past. This 4 year cycle that we've been addicted to, where it's basically 3 years of a bear market and then 4 years of a bull run. Oh, sorry, 1 year of a bull run. Many people say that is over. We can see many things that are different this time, but equally we can see some things that do line up. I close off with this though. When it goes to the altcoins, what typically happens is Bitcoin, gold goes first, Bitcoin goes second, and then the altcoins go third. And the big players do it this way. They make their profits in gold, they rotate some of those profits into Bitcoin, they make big profits in Bitcoin, and then they rotate some of those profits into the altcoins. That seems to be the natural progression of where this money flow goes through when the bull run occurs. What is different this time in this cycle with that is that, so, sure, gold's done a run, it's done very well, and silver, congratulations, silver's done really well. I've been stacking silver for many years, but it's big, it's heavy, it's slow, and sure, I've got a lot, but the profits I've been making in silver is nothing compared to what I've been doing in crypto. But that aside, now when we see if it plays out this time of gold goes first, profits rotate into Bitcoin, then profits rotate into the altcoins. The difference this time with the altcoins is that in previous bull runs, we've had, well, back in the early days, a few hundred altcoins, then a few thousand altcoins. But now we've got millions upon millions of altcoins. And consequently, those who have invested in altcoins and expect to get huge gains, the issue is that there's a lot of dilution in this rotation of money going into the altcoin market. Now, I still believe there are many altcoins that are going to do very well, but unlike 2017 as an example, where you could just stand at a figurative or metaphoric altcoin dartboard, you could blindfold yourself and throw a dart at the board, and no matter what number it hit, you would win. And it really was that simple because there weren't that many altcoins, and there was this massive rotation of huge amounts of money going into very small market caps, creating huge opportunities. Those days are gone now, simply because there are so many altcoins. People understand also the risk with altcoins, and may we say perhaps that the retail investors are kind of broke. We've had massive inflation. Interest rates have been so high. And even if they're pulling back interest rates now, they're still relatively high compared to what we were doing 5 years ago. The cost of living is up. Expendable cash per se is down. And consequently, the retail investors may not be coming into the space as they did before, where the institutional investors, it's the complete opposite. They're lining up, they're putting in big money, but they're not putting big money into shitcoins. They're putting it into Bitcoin and Ethereum.
Yeah, and it's interesting. Did you see the JP Morgan report on this event? And they highlighted a couple of really interesting observations. The first one was that, in fact, it was not institutional investors who were actually bailing out. It was actually retail investors.
That's
And
right.
I think my observation is a lot of people, the retail end of the market in particular, weren't attuned to these sorts of volatile environments and probably panicked. And there were also just one or two big whales that did some big plays, and people are speculating on what that whale or who those whales were and what they were doing. Because of course, if you're actually betting on the markets going one way and it goes the other way, you might win, you might lose, depending on where your bets are. So there was some specific dynamics here, which is worth, I think, understanding. But the point I want to underscore, and this is the discussion that you and I have had over the last few years, is more and more of the world of Bitcoin is now occupied by big structural players from the traditional financial system. So to an extent, we've now got Bitcoin and the main financial systems universes merging. We've got Trump, of course, preaching the gospel of crypto, and of course, actually releasing his own coins and what have you, although they haven't done necessarily that well, but nevertheless making a lot of money on the way through. And so these two universities, which were sort of disconnected to quite a large extent, and the very benefit of Bitcoin was seen to be because it was outside the traditional finance system, is now sort of, well, it's knitted fundamentally into the financial system overall. Now that changes the game, it seems to me, quite significantly.
Yeah, I'm glad you raised this. So yes and no. We believe, so here's a theory. And again, no one can truly know. So but some people say, no, it's not this. And others say, yes, it is that. I emphasize, no one really knows. And I also emphasize, and this is where you and I share our values, is that question everything. And this is why we explore these ideas. So here's the deal. The reality is that Bitcoin is one of the first assets in history where the retail investors has had the opportunity to front run the market, where not the big banks, not the big financial institutions, not the fund managers, where 18-year-old kids minding on their computer managed to get into this asset first. And these kids, now adults, made unforeseeable amounts of money. After 16 years, we're coming up to 17 years now. In the big picture, we're nearly at 2 decades of data where we can look at this and we can say, well, hang on a second, Bitcoin has proven itself. It didn't have the 51% hack. It wasn't for terrorists and tax avoiders. It actually is infinitely scarce or finitely scarce. We can actually see that all the competitors, the better Bitcoins, they didn't play out. So we have the data now. Now we have the data. Before we didn't. The big boys, the BlackRocks, the governments, the Michael Saylors, they realize, hang on, the banks themselves, they realize, hang on, this is a legitimate competitor. This is something very serious. So what they want to do, and understandably, they want Bitcoin. They want Bitcoin, but they don't want to pay $120,000 for a Bitcoin or $150,000 for a Bitcoin. If they could have their way, they'd be paying $1,000 for a Bitcoin. But the truth is, no matter what shenanigans they play in the background, no matter how many times they try to spook the market, we see, and of course, this line of support could drop, or could go down low, or could be broken. $102,000 to $104,000, that line of support, it doesn't seem to be able to be broken. So we can see that in the olden days, the way the big boys used to spook the market. So they wanted cheap Bitcoin. Let's go back in time when Bitcoin was around, I don't know, 40 or 50,000 US dollars. A whale who wasn't a government or an institution, it was just a guy who had a lot of money. He wanted to get more Bitcoin. He didn't want to pay 40 or $50,000 for a Bitcoin. He wanted to pay $20,000 for a Bitcoin. So what this whale would do in the past is that he would take 10, 20, 30,000 Bitcoin, he would take it out of cold storage and he would put it onto an exchange. That would trigger a whale alert. And the whale alert would go out to all of, at that time, Twitter and all the email distribution lists and say, alert, alert, alert. A whale just put, pick a number, 20,000 Bitcoin onto an exchange. A whale's about to sell. And consequently, everyone would be like, oh my God, Bitcoin's about to drop. Everyone sell, 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 sell. And that would drop the price. Well, what the whales discovered is like, hang on a second, I don't even have to sell my Bitcoin to drop the price. All I need to do is move Bitcoin onto an exchange, and that will trigger a whale alert, and that will drop the price. And then I get to buy from all of these chumps. And the whales were playing that game for years. They were moving these huge amounts of Bitcoin from their cold storage wallet onto an exchange. It would spook the market, the price would drop, and they would just scoop up and buy from the chumps. Fast forward to where we are now. Those whales have lost their power to the extent that now you have the big boys coming in. You've got the BlackRocks coming in. You've got the governments coming in. You've got whoever's got these stupid amounts of money. They're trying to play the same game, but it doesn't work the same anymore. Why? Because we've got up to 17, nearly 17 years of data. We've got diamond hands who will never let go of their position. We've got a very short supply on exchanges. The mining rate is low. Essentially, demand is high and supply is low. Therefore, price remains high. What's happening now, though, of course, is that we saw with this big short squeeze, or rather a liquidation of longs, is that people were getting greedy and they're like, well, how do we get cheap Bitcoin? Moving Bitcoin onto an exchange, that doesn't work anymore. Now, this is where the conspiracy theories come in. How is it that there was a few big whales that put millions upon millions of dollars in short positions, 30 minutes, some of them even less, before the price dropped? Now, and what dropped the price? We're talking about what happened in the last 10-ish days. What dropped the price is that Trump said to China, hey, we're going to put 100% tariffs on you. Now, we've seen that the market is spooked when Trump says 100% tariffs on China. Everyone dumps their Bitcoin very quickly. Now, when I say everyone, again, it didn't go to zero. It went from 120 grand down to 107 grand. And again, in crypto, that's not a huge deal, but for normies, yeah, it's enough to spook the market. So this time when it happened, someone knew that this was happening. Now, who was it? Was it Barron Trump? Some people say it was him. There's no proof of that. Was it a Trump administrator just who happened to be in the room? I've got no proof of that. Was it Trump himself? I've got no proof of that. Or was it China, who China knows that, well, hang on a second. And this is where you really got to think in four-dimensional chess. Trump is actually very predictable. Many people say Trump is unpredictable. No, he's not. He's very predictable. We know, history shows that if China says, right, we're going to play hardball with you, Trump will immediately react and say, right, 100% tariff on you. Now let's think in four-dimensional chess. If China knows that if they try to push around the bear will react with 100% tariff. And then the next step from that is the market is going to dump. Maybe, and again, I don't know, no one knows except the person who did it or those who were in the room. Maybe on this recent pullback, whoever it was, they wanted cheap Bitcoin. Maybe it was Trump, maybe it was his son, maybe it was an administrator in the room when the decision was made. Or maybe it was China that said, hey, let's get some more cheap Bitcoin ourselves. Even though we're getting gold, let's hedge our bets and get some of this Bitcoin stuff, the digital gold. Let's tell Trump that we're going to, grip up the rare earth deal. We're going to put some pressure on him because we know that Trump's going to put 100% tariff on us. And then we know that Bitcoin is going to drop. So let's short the crap out of this position. Let's make a few $1 billion in 30 minutes, or even hundreds of millions of dollars in 30 minutes. And whoever it was, they made twice. They made twice because they shorted the position just before the price dropped. They put crap loads of leverage on short. Now think of it. It was a bull run in October whilst markets are going up. And 30 minutes before, someone or something, as in an organization, put millions upon millions and millions of dollars in a short position with lots of leverage in a bull run. And 30 minutes later, the tweet comes out, or the Truth Social post comes out saying we're putting 100% tariffs on China. The market drops. And when the market drops, some platforms showed it went to $104,000. Other markets showed it went to as low as $102,000. And once it got to that price point and the market started to pivot, they they bought the crap out of the position again. So they won twice. They won on leverage short positions. And then when the market hit that line of support above $100,000 and then jumped back up, they bought their position again. Now, of course, then you had revenge trading. It's really fascinating stuff. The revenge trading was all the retail investors like, right, I've just lost all my positions have been wiped out. I'm going to revenge trade this. So a lot of people put long positions in again whilst it started to go up. And the same thing happened again, Martin. What happened again was this whale, whoever it was, they put in another short position. Now, if you remember, before I told you what used to spook the market was whales moving Bitcoin onto an exchange. That would spook the market. This time, that game doesn't work as much because a lot of the big boys aren't moving this much crypto and the demand is so high whilst the supply is so low. This time, that same wallet address allegedly shorted a massive position again. And because the whole market had just been spooked from this big whale shorting the position and then the entire market dropped, he did it again. And he's like, he didn't tell anyone. We've just got on-chain data where we can see all of this. This is where it's so ironic that crypto is so transparent, so open, that it's almost a danger to ourselves because when this played out again and the big whale shorted the position with leverage again, everyone was spooked again and that pulled down the market again. It dropped, he bought at the bottom and it scooped up again. At the end of the day, you spoke about it's now the institutions game. The architecture of Bitcoin does not change. They cannot print more Bitcoin. They cannot hoard more Bitcoin by confiscating it. They cannot start mining faster. They can, as I mentioned, with the dollar, you print more. With gold, you mine more. But with Bitcoin, you can't do either. You can't print more at a faster rate because there's a set supply, but you can't mine more at a faster rate because the block rewards are etched in stone. We've got 450 Bitcoin being mined a day. That's it. It doesn't matter how powerful you are, what whale you are, what BlackRock you are, what Trump you are. You can't get more than 450 Bitcoin a day out of the code. So, yes, the big boys are here. Yes, the game is evolving. Yes, there's now huge amounts of money playing in this. But the beautiful thing about Bitcoin is that it's still equal for everyone. If you were someone in everything that I just described, had you just bought Bitcoin and kept it in your cold storage wallet or even on an exchange, the exchanges didn't go down, Bitcoin wasn't hacked, nothing broke. All that was happening was humans were playing the human financial psychological game in the background. And those who know the game had buy orders in low. This is what happened to me, Martin. In that whole mess, what happened to me? I got a lot of cheap Bitcoin. Why? Because I put buy orders in low and I don't even worry about it. And I went to bed one night and I woke up and I'm like, oh, I just got Bitcoin at $105,000 in my sleep. Why? Because I put the buy orders in weeks ago, and I'm like, well, if Bitcoin drops to 105 grand, the buy order will be triggered, and it did happen. So had you not been using leverage, had you not been stuck to your screen, had you not reacted psychologically to this, had you simply stuck with the plan of dollar cost averaging, putting in buy orders low, and not flinching every time the market does something, what would have happened is you simply accumulated more Bitcoin at a lower price. And if you did the opposite to that, what you did is you handed over your Bitcoin to the big boys.
Yeah. And that, of course, is part of the game, isn't it? That quite often the ones who are more sophisticated and know what's going on are able to actually leverage to the advantage of ordinary investors. And this is what I find frustrating. And by the way, I draw an analogy to gold at the moment, right? If you look carefully, all that rush of retail investors going and buying gold, queuing outside ABC Bullion in the middle of Sydney.
Yeah.
When you've got to that stage, you are near the end game with regard to the particular story, right? Unfortunately, it's often the way that it's the people at the end of the chain. I don't mean a blockchain here, but at the end of the chain, in terms of sophistication and capability, are the ones who actually bear the losses almost always. And it's the more sophisticated people who are actually playing the game and basically profiting from that same game. And I think that's what we've seen relatively recently. Now, whether it's the US government or whether it's other players, I don't know. But the point I really wanted to sort of get to was that, there are things that have changed dramatically from where Bitcoin was, but there are also things that are immutable because of the definition of what Bitcoin is and how it operates. I'd also make the point, of course, we had the AWS outage yesterday, right? And I noticed that there were some people highlighting the fact that, well, Ether had a problem. At least some people. Here's a particular screen grab that I saw of one particular error, right? Now, I don't know what that means quite, but it would suggest to me that, again, when systems go down, what is the implications? Did Bitcoin go down? Was it affected by the AWS outage yesterday?
You are nailing the questions tonight. No, that wasn't. I remind you also when Bitcoin, do you remember a while ago that we had this big outage in Australia where, the planes couldn't fly, the check-in counters didn't work, the ATMs broke down, yet the point of sale terminals shut down, nothing would work. And it was like, oh, look, it's all fallen to pieces. Well, of course, no one said, well, Bitcoin didn't break. Bitcoin didn't miss a beat. Bitcoin is the most secure, most powerful, most stable network in human history. Now, that triggers a lot of people, but it is an objective truth. It is an objective truth because it's got more nodes and more mining power and more decentralization than anything, anywhere, ever. We've got nodes floating around on satellites out of this Earth. And people say, well, what if there's an EMP? Well, there's no EMP that we know of that can take out all of Earth. But I remind you that if there's an EMP that takes out all of Earth, your money's going to be worth crap as well. And you think, well, I've got gold. I can assure you, if we have mass chaos in the world, your gold means nothing. What matters is food, water, shelter, transport, fuel, and ammo. So I'm not saying gold doesn't have a value here, but we're already using digital anyway. And Bitcoin is resilient to these type of issues. Now, AWS, what happened with AWS is their servers, for those who aren't tracking it, imagine just a wholesale storage company where you can buy storage instead of just having it on your computer, you can put it in the cloud. And the cloud had a bit of a glitch, a big glitch, if you will. It went for a day. Now, many chains are actually using AWS servers to hold, if you will, their nodes, their ledgers per se. And some of the access to these price feeds, to this information, that was not accessible. That didn't happen with Bitcoin. Now, I run a node on my desk right here. I'm not affected by AWS, but many people run nodes all around the world. And a node is just, in simple terms, it's just storage of the ledger. The miners are the confirmation of transactions. In very simple terms, there's three parts to the Bitcoin network. I'm oversimplifying it here. One, you've got the users of the network, the peer-to-peer, if you will. Two, you've got the nodes who store all the information, who store the blockchain, who store every transaction. And three, you've got the miners who validate those transactions. Now, again, I've overly simplified this, but that's the three main parts of the network. Those who use it, those who store it, and those who verify it. When AWS went down or had a glitch, even if there was someone who stores a Bitcoin node on AWS, which a few people do, it doesn't matter. There's tens of thousands of Bitcoin nodes all around planet Earth that have nothing to do with AWS. Equally, there's hundreds of thousands, if not millions, of ASIC application-specific integrated circuit miners, ASIC miners, all around planet Earth that have absolutely nothing to do with AWS. And this is what we talk about the power of decentralization. So what we can actually see from AWS going down it was a good indication of this is why decentralization is so powerful. Because if your servers go down, it doesn't affect us. If you've got all of your nodes stored on those servers, that doesn't affect us because we've got nodes everywhere. And it also highlighted those coins that are more centralized by nature, they were had more effect from the AWS going down. Equally, we're going to see in the future, most people aren't even going to realize this is going to happen. Your applications, like application on your phone, and people think that you press a button on your phone and the stuff is happening in your phone. No, the button on your phone, the application on your phone is just an interface. It's all happening on someone's server, typically an AWS server. So when many people couldn't use their applications on their phone, or many people couldn't access applications or files that were stored in AWS, had that been decentralized, a decentralized application distributed in many nodes in many places, it wouldn't have affected them, just as Bitcoin wasn't affected. So now we see, this is the power of decentralization. If one node, if one server, if one validator per se goes down, it doesn't affect the whole network because we have millions of them floating around Earth or stationed on Earth, and even a few more floating around quite literally on satellites out of space.
Yeah, and it's interesting because a few people have said, well, some of the exchanges were inaccessible, etc., etc. But that's a different layer, isn't it, compared with the underlying Bitcoin ledgers, which is, as you say, held in multiple places and is more immutable. So it's really fascinating. And again, I'd highlight all of the noise over the last 24 hours, people talking about, oh, we've become too networked, we're too connected. It's people
Now
are
we're too centralized.
yeah, exactly. We should outsource more to other smaller players, etc., because there are basically
Yes.
three providers who provide something like 80% of all the cloud capacity in the world. Guess where they're all located?
The States?
Funny that. Yeah, exactly.
Yeah, who
So
would have thought?
yeah, who would have thought it? And the interesting, people in the UK have been saying, "Oh, actually, we've got our banks who actually have their critical systems over there," and one bank disappeared. They had no capability to do anything for a period of time. So it shows you the degree of dependency there is in the general world when it comes to the technology that's going on. But I don't believe that this fundamentally shone a laser on Bitcoin in a negative sense. In fact, probably more in a positive sense because of this immutability.
Well, it's funny, isn't it? Because I would like to agree with you in the sense that it should have shone a positive light. And the truth is that it did for those who take the time to actually dig a little deeper and say, well, what happened to Bitcoin? As you have just done here. It's like, well, nothing. Bitcoin didn't miss a beat. Just the same as that last time as I said, all the ATMs and all the checkout counters and all the point of sales, they went down. You didn't hear anything on the news saying, but Bitcoin didn't miss a beat because that doesn't form the narrative. It's like, well, hang on a second, who's sponsoring us here? Who's our lobbyist? Who pays for this show? Well, the banks pay for it. Don't let them know that their competitor that doesn't even have an office didn't miss a bloody beat and cannot be attacked. Now, of course, many people say, well, what happens if the entire grid goes down? How do I buy food? Well, this is where you and I believe in cash, and we also, to an extent, believe in barter. But I remind you all, so I've got silver here, right? Here's an ounce of silver. How do you know that's an ounce of silver? If the grid goes down and I go to Woolworths and they say, right, sorry, all of our terminals are down, and I go, right, how do I buy food with this? And I say, well, I've got a silver coin. How do they verify it? And you say, well, Adam, they just get one of those little machines that go blip. Well, Woolworths doesn't have one of those little machines that goes blip. And if there's mass pandemonium on the streets, as I told you, Your gold, your dollars, your bitcoins, that doesn't mean anything. That's like Armageddon stuff. You need food, ammo, cigarettes, alcohol, they become good bartering, labor, some type of an exchange, but you also need to be able to have fuel, and there's lots of other things when there's mass hysteria. The point I'm trying to make here is that when I do a transaction with this coin here, the transaction is not the verification. The transaction is, can I have, this is an ounce of silver, so it's worth 50 US dollars at time of recording. And I say, can I get $50 worth of groceries? Here's the transactions. Well, Woolworths goes, well, how do I know that's real silver? And I'm like, well, you have to verify it. Well, how do you do that? Now, even if you say, no, no, I'm doing it peer to peer, it's like, all right, well, I'll go to the street. I'll go to some guy on the street and say, well, here's an ounce of silver. And they say, well, how do I know it's a real ounce of silver? And this is the thing that I want everyone to remember. In Bitcoin, the transaction is the verification. The transaction in gold is the transaction, it's not the verification. So I'm not saying you can't verify silver or you can't verify gold, but it's not as simple as simply passing something over from point A to point B. Now, in the digital space, the transaction is still not the verification. Need proof? People need to look at what batch transactions are and what chargebacks are. So if I go to a shop or buy something online, as a consumer, you think, well, this is really great for me. But as a vendor, the person selling the product is a pain in the ass. So you sell something online, you send, I don't know, a t-shirt. You buy a t-shirt online, that you send a t-shirt as the vendor, you do everything properly. And you say, well, I got the transaction because MasterCard sent me the money. No, they didn't, because you can have you can have a chargeback. It's not actually verified. The transaction took place, but it can always be charged back. So it's not actually verified yet. Whereas with Bitcoin or most cryptocurrencies, there's been chargebacks with stable coins, which we'll get into in a minute. We can see that once you do the transaction, that is the verification. It's finalized. It has finality. It is done. So there are huge advantages to have a transaction that is the verification. And there's many instances in modern society that we don't realize that the transaction is not the verification. A quick example, when I lived in the United States, I remember every time I'd hand over a bill, and this was years ago, bigger than a $50 note, that was the transaction, but they still had to verify that bloody note. And I can remember clearly, and it was so odd to me, that the checkout chick or checkout operator would get one of these special pens and they would draw on the note. And that sometimes they'd hold it to the light or hold it under a special light or do the special pen to verify the transaction. Now, you might say, well, that's just a simple step. It's still another step where the transaction was not the verification. That is not the case with Bitcoin.
Yeah, absolutely. The model is quite different. And just on the cash thing, it's getting really serious in Australia again because the branches are being closed. It's harder and harder. There's less cash in circulation. ATMs are still being removed. Bitcoin ATMs are also under pressure at the moment as well, but that's a different story. The point, though, is that the volume of cash transactions in the economy are not going down. There are still more people wanting to use cash and hold cash. And in fact, there is more cash in circulation than ever. So there's something, again, between the mythology of what's going on and the truth of what's going on. And the truth is that there are people out there who actually think it's really important to hold cash just in case of emergency. And just recall the bushfires from a few years ago, or the floods more recently, when the system went down, the network went down, and people were unable to transact unless they had cash. So to my mind, cash is a critical, important stabilizer in society and an enabler, particularly when things go wrong. So folks, hold some cash even if you don't use it regularly. And actually, if you look carefully, if you think about it, it's fascinating to me that if you are paying by card, you're paying fees. If you're paying by cash, you're not paying fees. Now, somebody's got to cover the costs of handling the cash somewhere down the stream, but at the moment, you can quite often get a better deal if you pay cash. That's another story that's not being pushed very hard, but for me, that's another part of this story as well. So it's just a little aside, but a really important aside here. The cash story is a critical part of modern society and must remain so, at least in my view.
So you and I, this is how we met. So for the viewers that don't know out there, Martin and I met because of the cash ban. Martin and I shared, and we still share the vision and the value of cash. That is, we should have financial privacy to the extent of why does everything, or should we have a peer-to-peer ability and financial privacy? That is, if I want to go and buy a bottle of wine or the Quran or the Bible or a naughty thing that's legal from a naughty shop, shall we say? Why does the bank need to have a record of that? So that's one part. The next part is the transactions that you just spoke about. The next part is what happens if the system goes down. Okay, so we all have consensus on that. We need to have the right, freedom of association, freedom of commerce, the freedom to hold our own cash, the freedom to not go into a bank and say, "Excuse me, can I please take out more than $2,000 of my money from my bank account?" And they turn around and say, "No, you can't do that." It's a horrific thing. Where Bitcoiners take it a step further, this is where a lot is lost in the translation of Bitcoiners. I take it a step further. We take it a step further and say, right, cash is great. What backs the cash? And that's the key point here. What backs the cash? It's not that cash is in and of itself bad. And it's not that cash is something that we're against and we're like, no, no, we only want the digital space. No, no, no. That's not what we're saying. What we're talking about as Bitcoiners is scarcity. If a central body, let's say I want to save $2,000 under my mattress, great, that sounds fair. But why is it fair that the government gets to keep printing and printing and printing and printing and printing and printing? And so my $2,000, it looks like $2,000 under my mattress, but it starts to go down to $1,900, $1,800, 17, 16, 15, 14, 13. Now, to the financially illiterate, which is the majority of people, not because they're bad, not because they're stupid, but because they've been denied an education on money, because money is a scam, fiat is a scam, the dollar is a scam. What they can't see is they say, no, no, Adam, I put $2,000 under my mattress and there's still $2,000 there now. What I'm saying is you're not looking at real value. You're looking at nominal value. The nominal value hasn't changed. The real value has changed. So the issue with cash, Martin, and I know you agree with me here, I won't put words in your mouth, is that it's not that cash in and of itself is bad and we want to turn our back on it. What we're saying is what backs the cash. And so as long as they keep printing money, the dollar, all dollars, are a scam. And fiat, the physical fiat that we hold in our hands, the dollars that we hold in our hands, yes, we should have that sovereign right to hold that money, to be in control of that money, to use it peer to peer. But so long as they keep printing the worthless crap in the background, it's all a facade. It's all a lie. It's all a scam. And so what we'd really, Bitcoin wouldn't need to exist if the government said, right, there are $1 trillion in circulation. That's it. Bitcoin would never exist. Now, sure, it'd be great for convenience of being able to text a 1 cent or $1 trillion or the Earth's entire global money supply from point A to point B without permission in a matter of seconds with almost no fees. That's really convenient with Bitcoin. That's fantastic. I can move Bitcoin from anywhere to anyone at any time of day with no permission, almost no fees, almost instantly. I can't do that with money. I have to go through a central body. I've got to get their permission. I've got to wait 3 business days if it's an international transfer. I've got to deal with exchange rates. I've got to deal with chargebacks. I've got to deal with blockages and stoppages and everything that the banks want to do. They are in control. That's not peer to peer. If cash in and of itself was one, a set supply, two, was totally movable, that is, I could send it anywhere to anyone almost instantly, Bitcoin wouldn't exist. It wouldn't need to exist. But so long as we are in a digital world, we need a digital money. That's a fact. What we're doing right now is digital. There's nothing wrong with digital money. And you say, well, Adam, we've already got digital money. Well, of course, they keep printing the worthless crap. So please, I ask that everyone, and I understand there's a lot of pushback on Bitcoin on this channel to an extent sometimes. If you want to learn more, come. I'm being very diplomatic here. I warn my community. I'm going to the lion's den. There are going to be a lot of haters. Bitcoin's not real. Bitcoin, I can't touch it. No, no. The scam is not Bitcoin. The scam is the dollar because they keep printing it. It's theft. They steal from you. They dilute your value. They rob you. And then they blame you, Australia, for inflation. They say, Australia, you caused inflation because you bought a cup of coffee. It's the most deceitful practice by any government, left or right, to blame the good Australian people who worked for their money, then created jobs, then paid taxes through GST, and created economic stimulus. And then the government turns around and said, oh no, everyone, it's your fault. You know that holiday when you went on? That caused inflation. No, it didn't. When I buy a cup of coffee, I don't increase the money supply. I move money from one point to another point. In fact, if anything, I decrease the money supply to the extent that taxes come out and they go to the centralized body of the government. I decrease the money supply to the extent that the banks get a cut out of it. I I am not increasing the money supply when I spend money. But governments lie to us and they say, no, no, you caused inflation. It's like, well, I didn't print money. Martin didn't print money. The cafe didn't print money. How did money inflate? Well, it inflated because governments and banks printed it. And that's where Bitcoin comes in. Bitcoin says there is a set supply. No bank, no government, no BlackRock, no Trump, no anyone can increase the supply of Bitcoin. Check. The next thing Bitcoin says is that we get to hold it ourselves. Not you, bank, not you, government, not you, third party. We get to custody it ourselves, just the same as custody in cash. The next part is it's permissionless. I don't need your permission, bank. I don't need your permission, government. I don't need your permission, MasterCard, to spend my money the way I want to after I earned it. Here's the other thing. Bitcoin says, I'm not going to deal with deflation. Sorry, inflation rather. It's deflationary to the extent of how much is available to everyone. It's divisible that where everyone can access it, but it's deflationary in the supply in the sense that there's less and less of it to go around. Therefore, it's inflationary in purchasing power. The dollar is the opposite. It's inflationary in supply, therefore deflationary in purchasing power. So when you actually see, all right, everything that's broken with the dollar, everything that is broken with the dollar is fixed with Bitcoin, with one exception, the physical aspect. The physical aspect, that is what's lacking in Bitcoin. Now, I've got solutions for that, but that will trigger a lot of people what my solutions are. It comes down to this. If you want money to be real, it must have a set supply. And anyone who goes, well, hang on, if it's a set supply, there's not going to be enough to go around. No, no, no. Digital is divisible. Where people get lost with divisibility, they say, well, hang on, if it's divisible, that's the same as expansion. No, if I take this ounce of silver and I break it into two pieces, I've divided it into two pieces, but there's still 1 ounce of silver. The same as with a Bitcoin. If I take one Bitcoin and I break it into 100 million pieces, which is called a Satoshi, I haven't increased the supply of Bitcoin. I've increased the access to it. And that's why Bitcoin keeps going up in purchasing power, whereas the dollar keeps going down in purchasing power.
Well, I come back to this concept of the value anchor, right? So if you think about it, it's like a seesaw, right? And the question is, where is the point of real value? And of course, if you talk to Peter Schiff, he'll say, no, gold is the value anchor, right? Because everything else relative to gold. And so he reports the movement of Bitcoin relative to gold. I've got other people who will say, no, it's actually Bitcoin that's really the critical answer, because it's the fact that it's actually, you can't inflate the number of Bitcoins out there, right?
That's right.
And there are other people saying, no, it's the US dollar that's actually the
infinitely printed.
Well, exactly right. And just on that, just so people know, this is the latest on the US debt, right? So you can see there that households' debt, non-financial corporations' debt, government debt, financial corporates' debt, it's all rising, right? So there's 100 trillion in the US. And by the way, the Congress Budget Office in the US is talking about the trillion now, 1.8 trillion financial year 2025. So it's continuing to go up. And The Economist actually published a very interesting article. I do recommend you read it if you've not seen it, called The Coming Debt Emergency, which is basically saying we're near the end of the road here. This can't go on forever. Now, it's very interesting. It'll go on for a lot longer than people think, because politicians are not prepared to tamp down on government spending. And a lot of the credit magnification that we're seeing is actually in the private sector. And Steve Keen, of course, really highlights this. He's put up a couple of posts quite recently highlighting that it's actually the credit momentum, particularly around mortgages, that have gone through the roof, which creates, every time a bank writes a new mortgage, they're creating effectively additional liquidity in the market. And that's creating more liquidity that creates more profit for the banks ultimately, but also increases the money supply. And the M2 has gone through the roof. It's continuing to rise. M2 in Australia is double the inflation rate at the moment. So that tells you there's more inflation coming, right? It's very strong in the US as well. It's very strong in Europe and in the UK too. So we have the situation where the value of each individual unit of currency is being reduced because of government strategy, because of the fact that the private sector, the banking system, is allowed to continue to balloon. And of course, then we have derivatives sitting over the top, which creates more uncertainty as well, and all ability to trade and ability to be able to, if you look at the price of gold, the underlying is one thing, then you've got the options over the top, which is about multiples of the underlying. So that magnifies some of the moves. So we are in a world where the currency system is being continually debased. And that's why this is an important conversation in the context of Bitcoin. And I come back to a very simple point. It's not that prices are going up, it's the value of your dollar is actually going down.
Well, in Bitcoin, it's the opposite. Prices are going down in Bitcoin. And it goes back to what you said, the anchor point. And everyone has to really ask themselves, what is the anchor point? And the reason why it can't be the dollar is because they keep printing it. Now, not just the US dollar, all dollars, all fiats. All fiats always fail. That is a fact because it's got no limit. So I think we can get consensus. This is where Peter Schiff and Bitcoin, we get consensus. We agree that the dollar is a scam. We agree that it's printed to an oblivion. And we agree that the reason why you're getting poorer is not because prices are going up. It's because what you're purchasing it with is going down in purchasing power. So to compensate to the loss of your purchasing power, you must increase the prices. But the government will tell you inflation is prices going up. That's not inflation. Inflation is inflation of the money supply. A consequence of the inflation of the money supply is prices go up because your dollar is weaker. Now we go to gold about the anchor point. Okay, so the anchor point is going to be gold. Well, what's the supply of gold? We don't know. No one knows. We don't know the circulating supply of gold, and we don't know the maximum supply of gold. So how on earth can gold be an anchor point if we don't know what the supply is? We don't know how much is out of the ground, we don't know how much is in the ground, and we don't know how much is at the bottom of the oceans. We don't know how much we're going to get when environmental laws change and we start ripping up rainforests. We don't know how much more gold we're going to get when we have submarines to go down to the deepest part of the oceans and dig up gold that we couldn't get before. We don't know how much we could get from. I know it's out there, but it's not impossible. It is a possibility that you could get gold from meteors, and oh no, that would never happen. All right, well, planes will never fly, and we'll never put a man on the moon. I don't know if that's ever happened. We'll never put a rover on Mars, and so forth. Technology evolves, so we say, well, what's the anchor point? And you're dead right. Now, all of us have to say, well, do you want an anchor point? This isn't pro Bitcoin at the moment yet. This is just let's do the thought experiment as philosophers. Should the anchor point be infinitely expandable? It's like, well, that's not going to work because if the anchor point's infinitely expandable, it's constantly moving. So no, it can't be infinitely expandable. So all right, well, should it be something that we don't know the supply of? And it's like, well, hang on, if we don't know what the supply is of the anchor point, then that's not really much different to infinitely expandable because it could go up a lot or some and therefore we couldn't measure it against it. So in the thought experiment of understanding money, the perfect money, if we want an anchor point, the supply must be known. It must be set. Once we understand, okay, the supply is this and it is set and can't be changed, then we have an anchor point. Then the anchor point exists. If you've read the Bitcoin Standard, they talk about the first one of the first money beyond beads and shells and feathers and leathers and so forth. They had this big island with these big rocks. Are you familiar with this?
Mm.
They had these massive rocks, and that the supply of those rocks was set. And isn't it amazing that this prehistoric per se civilization understood that the anchor point, ironically, something that couldn't be moved, think about that, in more ways than one. It was set in stone, quite literally. That was the anchor point. And they had consensus that this is the anchor point, and we can start dividing, if you will, the anchor point to the extent of like, right, you own half of this rock, you own half of that rock. And then we had, if you will, a ledger. And so now that's it. Once you understand that's like, okay, so we need a set supply. We can't increase the supply. We need to know what that supply is. And we need to be able to see who owns what of that supply. Everything I've just described is Bitcoin. That's why it works. That's why the purchasing power of Bitcoin goes up, whilst the purchasing power of the dollar goes down. Now, if we go to gold and we say, Adam, the price of gold has gone up, the nominal price has gone up, the purchasing power has not gone up. It's not one for one. I acknowledge it's constantly shifting like this, but gold maintains its purchasing power. That's not good or bad. It's just is what it is. But when financially illiterate, and again, I don't mean that in a derogatory way, I mean it because we have been denied a financial education because we are all subjected to the biggest scam in human history, which is the dollar, all fiats, the pound, the euro, the yen, whatever currency, whatever stupid name they want to give it, whatever scam name, whatever clown world they want to label this stuff, that's the scam. So we look at gold and we say, hey, Adam, look, gold hit a new all-time high. No, it didn't. The dollar hit an all-time low. That's what happened. Because what's the anchor point? Well, we're comparing gold to a sinking ship. So if the ship is sinking, as you said, like a seesaw, the ship is going down. Look, gold is going up. Gold's not going up. Gold maintains a consistent purchasing power. Now, that's not good or bad. It's just a matter of fact. An ounce of gold has pretty much always bought the equivalent of a men's suit and pair of shoes, whether it was a toga and a pair of sandals in ancient times, or a tailored made men's suit today. English is fun, and a pair of shoes. That purchasing power has remained consistent. But the financially illiterate or the or the salesman, like Peter Schiff's, to be blunt with you, look, the price has gone up. The price did go up because the dollar went down. And so as a seesaw effect, what you're seeing on the gold charts is not gold hitting an all-time high. What you're seeing is the dollar hitting an all-time low.
And that's really the point. That's why I use the seesaw analogy, because I think it's the most
Mm,
powerful way of trying to visualize what's actually going on here, right? And of course, it also gets to the multiplier effect, because the further away from the center of the fulcrum it is, the more it can move around, which is, I think, another important point too,
well
right?
said.
Yeah.
Yeah.
Now, the other interesting observation here, and just we'll pull this slide up here, the total value of the coins at the moment, according to this data here from CoinGecko, is that we've got roughly market cap across the global cryptocurrency market of 3.75 trillion, right? A little bit of a fall, but interesting that Bitcoin is about 2.15 trillion, and that's 57%. Stable coins are at 314 billion, and there's an 8.38% share of the total crypto market cap. And it's interesting if you look there, and this is actually the mixture of Bitcoin, Ethereum, stable coins, and others. And if you look at stable coins in particular, you can see there that you've got things like Tether up the top there, and USDC and a few others too. So this takes us to a very interesting part of the discussion, Adam, which is the stable coin argument that's going on at the moment, right? There's been a huge shift, particularly in the role of stablecoins and particularly in the US, which I'm not sure that people have actually caught up with. And for me, this is a really important conversation, not least because if you think about what I showed with regard to rising debt, well, that has an interesting complication if you think about stablecoins and the way that stablecoins are meant to interact with the US dollar and also with crypto. So can you take us through the stablecoin events of recent times and talk about the US bill that was passed and the consequences and how you think this is going to play out?
Again, nailing it with the questions tonight. This is a really important subject that I encourage the viewers to. We're now talking about stable coins, which is not Bitcoin. We are now talking about the digitization of a dollar to make it more user friendly. Okay, so let's go through the history of a stablecoin. What's a stablecoin? A stablecoin is simply a crypto asset that's pegged one to a fiat currency. Now, we think of stablecoins being linked only to the US dollar, but the truth is you can peg a stablecoin to any currency. The Australian dollar, the US dollar, the yen, the euro, it's irrelevant. But let's stick with the US dollar for now. Okay, so why was the stablecoin invented? Stablecoins were first invented by Tether many years ago in a way for crypto traders to move dollars or money or value from one exchange to another. So let's say you're trading on exchange A and you want to go over to exchange B, but you don't want to move Bitcoin because it's volatile. You don't want to move any other coin because it's also volatile. What you want to do is you want to move a stable asset that's pegged one to the US dollar in this example. Okay, so that's why stablecoin was created to move value currency from one exchange to another. It then evolved, and it's like, well, hang on a second. When I'm trading in and out of Bitcoin, as an example, or or Ethereum or XRP or any cryptocurrency, instead of trading from Bitcoin to XRP to Ethereum and so forth, I can trade in and out of my position using a stable coin. So I can move out of my stable coin, which is stable to the extent that it's pegged to the US dollar. Now, remember, it's still losing its purchasing power the same way as the US dollar is losing its purchasing power. But as a nominal amount, as a nominal value, it remains consistent and stable and pegged to the US dollar. So traders started saying, well, hang on a second, I can now trade in and out of Bitcoin and XRP and pick your coin, doesn't matter, going in and out of my position using a stable coin. It's like, wow, this is a really good tool. This is a fantastic tool. I can move value from this exchange to that exchange. Then I can go in and out of the markets, all in the cryptoverse. I don't need to go to a bank. I don't need to use cash. I don't need to wait for a 3-day business transaction. I can do it instantly. This is fantastic. Then what happened is it's like, well, hang on a second, all of us who were working in crypto, as an example, one of my years ago, someone in Romania was working for me, and he needed to be paid. I'm like, well, why on earth would I use the Swift network that's going to take 3 days? Why would I use Western Union, which is just a load of crap and it takes 3 days and needs so much paperwork and permission and fees and transaction um, exchange rates? Why don't I just text him or send him just the same as I can send an email? Why don't I send him a digital dollar? And then the whole world's like, hey, man, this thing's really cool because now I can just text money to anyone in the world. Now, some people go, well, hang on, Adam, I can already do that, where I can use my mobile phone and text Jono down the street some money. Stop thinking locally, start thinking globally. When you want to move money from Australia to London, you need the Swift network, you need permission, you need at least a certain amount. You need to deal with exchange rates and banks' permission and all of that. Whereas now a stable coin, you could do it with crypto anyway, but you could remove the volatility from crypto. You could use a stable coin and you can still use it, and you can text it from point A to point B without any permission, without any spread, without any fees. And the fees, there are some fees, but they're so minute. They're absolutely nothing compared to the Swift network or a bank, without any delay and without any hassle. That's why we use stablecoins so much. But and then they evolved even further. And it's like, well, hang on a second. When I now travel in, pick Cambodia as an example, I'll just pick some poor country. Nothing against my good Cambodian friends, beautiful country, beautiful people. So I'm in Cambodia and the Cambodian currency isn't so strong. And I go as a tourist and they say, do you have US dollars? And I'm like, well, I don't have any cash, but do you take stablecoin? And they're like, hang on a second, I'll take stablecoin. Why? Because it's as good as the US dollar, because it's pegged to the US dollar. I don't need cash. Everyone's got a mobile phone. And now I can text money and use money whilst I'm a tourist in a country who's got a QR code and a phone and use it as a stablecoin there. Now we take it a step further. It's like, well, hang on a second. We'll use Venezuela as an example. No, probably not a good example because the US dollars, well, no, we can still use it. In Venezuela, inflation is so bad that the government keeps printing their money so that their currency keeps dropping. And it's like, well, hang on a second. If I use the US stablecoin, even though the government said you can't use US dollars here because bad America, I still have access to the internet. I still have access to my phone. And I can still use US dollars in Venezuela, Cambodia, Vietnam. Pick your nation. It doesn't matter. I don't need a bank. I don't need permission. I don't need 3 days to wait. I don't have any slippage. I don't have any spread. I don't have any exchange rates. I have barely any fees. Why wouldn't I use the US dollar in this instance? So we went from a tool that was to move value from one exchange to another, that went to then trading, which went to texting money around the world, which went to tourists using it more efficiently than cash, which went to locals in developing and poor nations to using just the US dollar. But even me in Australia, in my privileged position, the Australian peso, to be blunt with you, Martin, is a piece of crap. So even me in a first world country, I'm like, why do I want the Australian dollar? Because it's got no purchasing power. All fiats are going down, but the US dollar is going down slower than all other fiats. Why don't I just start saving in a stable coin US dollar? And now and again, I don't need a bank. I don't need permission. I can send it to anyone. I don't have 3 business days. I don't need to ring the Commonwealth Bank or ANZ or Westpac or pick your big bank and say, "G'day, bank. May I please have $2,000 of my own money next Thursday?" And they say, "What are you going to spend it on?" And it's like, none of your damn business. Well, we're not going to give it to you. I don't need any of that system now. Now, of course, all of this exists, what I've just described, in any crypto anywhere, but the stablecoin power is that it's pegged to the US dollar. Okay. I'm now going to go to the next evolution of the stablecoin. But before I do, are there any questions on what I've described with the history of the stablecoin to what it's about to evolve to now?
So just the actual physical mechanism of pegging, right? Does that mean you've got to actually have US dollars one for one to the value of stable coins issued? Or can it be a multiplier? Or can it be just a theoretical peg?
That is the perfect question and the perfect segue into where we're about to go to. The rule was uh, that yes, it must be one to one. So if you're going to issue $1,000 in stable coins, you must have $1,000 of cash in reserves. Then that expanded a little bit to some other real assets that were high liquidity, high value assets that were recognized. But for all intents and purposes, yes. If you were Tether as an example, if you were going to issue 1 million stable coins, it had to be backed by $1 million cash. Now, everyone might be saying at this stage, well, hang on a second, Adam, how does Tether make any money then? Because of the transaction fees. The very tiny transaction fee, very, very tiny, nothing like the banks, nothing like anything that we deal with now. But if I can issue you $1 million, and every time that $1 million, not just once, but forever, bounces around the world in all of these wallets everywhere, I get a very small transaction fee. That's good stuff. And what Tether did in this example, it went when Tether first came out, I was skeptical of it as well. I'm like, this is bull BS. I said, look, I can just print numbers on a screen and I can make stable coins. And I was skeptical of it as well, but Tether proved itself. What Tether did was they had multiple audits and said, come audit us. And they did. And they found, yeah, it is one for one. But Tether took it a step further. Tether took many of their profits and they went and bought Bitcoin when Bitcoin was a few $1,000s. Well, now Bitcoin's worth $108,000 at time of recording. And so Tether in itself made huge profits, massive profits from the transactions. But from their profits themselves, they invested that into high yielding and high return assets. And as a result, Tether is one of the most successful companies on planet Earth because they've only got about 20 people working for them, like 20. And they're running more money around the world than many economies and many banks with 20 people. Okay. So now that we know that a stable coin has so much utility, people are like, why would I use it? And the other thing you can use with stable coins is I can take my stable coin, I can lock it into decentralized financial products, and I can earn yield. As an example, let's say a bank pays me, I'll make up a number, 5%. If I'm lucky, let's say 3%. That's 3% of the Australian peso. Crap. But if I use my stable coin and put it into decentralized DeFi products, I can earn 7 to 10%. And it's like, well, hang on a second. Not only can I double what the bank is offering me, but I can earn it in US dollars. Why wouldn't I do that? So everyone who's understanding this, like whether I'm Australian or British or Colombian or Venezuelan, I can take the US dollar as a stable coin, lock it into a DeFi product. It's backed one for one. It's got a decade of a track record that proves it's good. And I can earn serious profit, some interest rates on it, some yield. This is a good deal. Now, I emphasize here, a stable coin in and of itself does not pay yield. Many people go, yes, my stable coin pays yield. No, it does not. Your stable coin is no different to a dollar. If you've got a dollar in your pocket, it doesn't pay you yield. If you take that dollar and give it to a bank and deposit it or a fund manager, then you start earning the yield. So stable coins in and of themselves do not generate yield. But if I put it to someone, give it to someone, then I can start generating yield. Okay. Now we introduce the Trump administration. What we're seeing in America is that, so what's the top of the Ponzi scheme? How is the dollar created? The dollar is created with a treasury. And for the purpose of this discussion, we're going to call a treasury, a bond, or an IOU one and of the same. So if I interchange between a bond, an IOU, or a treasury, everyone know that I'm saying the same thing here. It's a piece of paper or a note or even an email to an extent where it says, I owe you $1 billion. Okay, so America needs $1 billion. America printed all the world's money. America bought all of this stuff from around the world. They went out to the world and said, can you make us stuff? And they said, yeah, what are you going to pay us? And we'll pay you with these dollars. Cool. So all the dollars went out to the world. Then America's like, we got no money. How do we get this money back? Like, we're not making anything. We need more money. How do we get it back? If we print too much, we're going to inflate away our own economy. How do we get the money back? I know we'll write an IOU, a treasury, a bond, and we'll go to all the world and say, hey, world, who wants to buy this bond? And the world goes, well, why would I buy your bond? It's like, well, we'll give you 5%. It's like, oh, okay. I'll take that IOU. Thank you, America. And here's your money back. Now, in return, what America would do is that they'd pay you five, as an example, they give you 5% yield. And of course, you get 2 years, 5 year, 10-year bonds, but that's irrelevant for now. And you would hold this IOU for, as an example, 10 years. You get a 5% yield on that. Every year you get 5%, 5%, 5%, 5%. And at the end of the 10 years, the government would give you back the US government will give you back your entire principal. Great, that was a good deal. We've been playing this Ponzi scheme for years, arguably for half a century, a bit longer if you go beyond the delinking of gold in 71. So it got to the point, though, that so many treasuries were printed and the yield was so crap. And the nominal yield may have looked the same, but because the purchasing power had gone down, the whole world said, hang on a second, I don't like this deal anymore. You keep printing this worthless crap. We produce real stuff. And then you pay us interest on your bonds with more worthless crap. We still produce real stuff. And as we saw recently, when the states went to the world and said, hey, world, we've got some more treasuries here. Who wants to buy these treasuries? And the world goes, no, we're not buying that. We can get better returns in Bitcoin. We can get better returns on the stock market. We can get better returns on our own currency, on our own infrastructure. We're not doing it anymore. So if the US government needs money and no one's buying their bonds, well, what do? Well, introducing the Federal Reserve, which is neither a federal entity that nor has any reserves of anything. And the Federal Reserve goes, all right, US government, we'll buy those IOUs from you, those bonds, those treasuries, but we want 5% paid on it. And the US government goes, all right, we don't care where the money comes from. So what you've got in America is that you've got one department which isn't a federal department and doesn't have reserves of anything. And you say, well, hang on, they've got reserves of treasuries, park that aside. They print money out of thin air and they give it to the US government. So now the US government owes itself money with interest on it. That's where we are now. And now the problem with that is before they used to export their debt through all of these treasuries, all of this inflation, the inflation was going and being shared with the whole world to an extent. But now, if they have to print their own money and give it to themselves and pay interest to themselves, they're about to go into unforeseeable inflation. So it's like, well, hang on a second. Trump and Powell, so the president of the United States and the Fed chair, they're not friends. They're not getting along. The United States government does not have control over the Federal Reserve. The Federal Reserve does not have to do what the president of the United States says. That's etched in stone. And this is the conflict that we can see. So Trump is in, and whether you like Trump or not, it doesn't matter. America is in a very difficult situation because they've got nearly $38 trillion of debt that they've got to pay off. It's about to tick over to $38 trillion probably by the end of the year. And they will need to pay $1.5 trillion, $1.5 trillion in interest on debt. And Trump is rightfully saying, hey, can you lower the interest rate? Can you please lower the interest rate? And they're like, no, we're not going to lower the interest rate because then inflation's going to run away. And it's like, well, I need you to lower the interest rate because I have to pay interest on $38 trillion. Now, for all the Trump haters out there, this isn't a Biden Trump thing. It's a fiat thing. It doesn't matter who was in the White House. That debt was still there. Oh, yeah, but he increased the debt. Every government increases the debt. The last one increased the debt ceiling, then they removed the debt ceiling. It's just like having an unlimited credit card. So please, everyone, don't worry about left or right of politics. The US government, both sides, have have increased their debt to nearly $38 trillion. The interest payments on that is $1.5 trillion probably next year. And they still need more money. Okay. So what do we do with stablecoins? Where stablecoins come in, this is where it's fascinating. Stablecoins now come in and say, well, hang on a second. US government says, hey, can you print us some stablecoins? Hey, Tether, can you print us some stablecoins? And they say, Tether goes, well, yeah, we'll print you stablecoins, but we need to back it one for one because that's the law. That's the law we made. That's the law you made. Well, hang on, it wasn't really a law. There's now a law with the Genius Act, which we're about to get into. We guaranteed our clients that we would back the dollar, the stable coin, one for one with a dollar. If we give you, US government, $1 billion, how are we going to back our stable coins? And the US government has now said, well, we'll etch in stone that you're able to back your stable coins with treasuries. Now, to be clear, many people go, no, Adam, in the past, these stablecoin companies had treasuries. That's not what backed their dollar. They invested their profits into treasuries to make yield on that. The big change with the Genius Act now is one, it recognizes stablecoins, it doesn't fight them. Two, it says we can give you treasuries. And then for stablecoin companies, Circle, Tether, name your company, you can print money out of thin air, just like the Federal Reserve was doing it, just like the banks were doing it. You can now print money out of thin air and you can back it with this IOU that we're going to give you. Now, Tether goes, sounds good to me. We don't care because all we have to do is we just go to our keyboard and go type, 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 type. Here's $1 billion. You give us an IOU with yield. So now we're getting yield on the IOU that we gave you. Oh, and by the way, you know that $1 billion that's circulating around the world? Every time there's a transaction there, we're earning a little bit of a profit on there because there's a bit of a transaction fee on all of that. This is a great deal. So now what's happened is that the US has leapfrogged, if you will, leapfrogged the Federal Reserve and said, hey, Fed, we don't need you. Hey, world, you know what? We don't even need you. We'll get to that point in a second. We're just going to issue treasuries and give it to the stablecoin companies, and they can print the stablecoins out of thin air. But it gets better, not for us, for the US government. They go, well, hang on a second. Before, when we printed money and lent it to ourselves, the United States people had to deal with that big hit of inflation. The money supply inflated, and all the American people got punched in the face with inflation because, oh, crikey, we've just lent money to ourselves. A little bit different when they got the money from abroad, but when they lent money to themselves, the main impact of inflation hit the American people. But here's the thing, Martin. Stablecoins, US dollar backed stablecoins, are already injected everywhere around the world. And it's increasing more and more and more. Why? For all the reasons I described beforehand. They're very convenient. I can save better in them. I can earn yield in them. I don't need a bank. They're very fast. They're very reliable. They're backed by the dollar. They're already throughout the world. So now what the US government can do is that they can print a treasury, give it to a stablecoin company, which is American. They can print the money out of thin air. And then that the inflation doesn't go straight to America. The inflation, in fact, goes to the whole world. And this is where Russia stepped up and said, oh, we can see what you're doing. We can see that you're continuing to print money. But instead of you bearing the brunt of inflation, you're exporting your debt, your inflation to all of us. And because there's such a high demand on stable coins and they have so much utility and they're pretty handy, which is demand and utility, people are using it, and that's why the stablecoin use is expanding. But it gets worse or better. Worse for us, better for them. That's what's happening now. That's where we are with the Stablecoin Act. The American government can issue treasuries to stablecoin producers or creators, and those stablecoin creators now have the full backing of the United States government to print money out of thin air, just like banks are doing, and the Fed Reserve was doing and is doing. But now private entities can do it. And the yield on those treasuries is paid not to the stablecoin users, but to the stablecoin issuers. So the law says that you can't earn yield as a stablecoin holder. Now, this is where it gets a bit grey. Those who issue the stablecoins, Tether, Circle, as an example, they get yield on the treasuries. But those who hold the stablecoins, they don't get yield. Now, again, many people say, no, I can get yield on my stablecoin. No, you don't. If you put your stablecoin into a decentralized financial product, that pays you yield. The stablecoin in and of itself does not pay you yield. This is where it's going. Let's say the treasury is 5%. That is, I'll give you an IOU. You print me $1 billion and I'll give you 5% per annum. Okay, fair deal. Well, what if the US government then goes, no, I'm only going to pay you 2%? Tether or Circle, as an example, we're only going to pay you 2%. It's like, well, it's still 2% on $1 billion. And all I have to do is push some numbers on this screen here. And I'm still going to get fees from all the transactions. So, yeah, I'll take that deal. Then it's going to, this is all my speculation now. Then it's going to evolve further and it's going to say, hey, Tether, we want you to print $1 trillion in stable coins, but we're not going to pay you any yield. And if you don't do it, you're going to deal with the full force of the United States government. And Tether goes, well, We better not mess with the US government. And if we print $1 trillion out of thin air, we're still going to get all the transaction fees on $1 trillion, not once, but every time this dollar moves anywhere around the world. Like we're going to be now by default MasterCard, that every time blip, 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 all around the world, I'm getting a fee, 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 fee. It's like, yeah, we don't care. It's only putting numbers on a screen. We will give you $10 trillion at 0% yield, and we're going to take the fees. Then it goes a step further, Martin. You ready? Why do you even need Tether? Again, this is my prediction now. You don't even need Tether. You don't even need Circle. This is the United States government. They can print their own stable coins. You don't need the Fed. You don't need banks. You don't need centralized cryptocurrency companies like Tether and Circle. You can just print your own stable coin. And the world is waking up to this. And Russia has gone, oh, we see what you're doing. But what are you going to do? The demand is on the US dollar. They're exporting the dollar everywhere. Everyone already uses the dollar. A stablecoin is now just a more efficient dollar. We can now leapfrog banks. We can leapfrog the Fed. We can even leapfrog eventually stablecoin issuers, and we can export our debt to everyone else. Now, just to close off on this, people say, well, how does that get rid of your debt? In very simple terms, it's this way. If the, and I know you understand this, Martin, but many of the viewers get bogged down on this, and it's fair because it's complicated. America's got $38 trillion worth of debt. Let's make the numbers simple. Let's say America has $1 million of debt. Wouldn't that be funny? And there was a total supply of money in the world of $2 million. So America has $1 million of debt, and there's $2 million of money floating around the world, which is mathematically impossible because money is born from debt, but that aside. America has 50%. 50% of the global money supply is America's debt in this example. They've got $1 million of debt. There's $2 million in the world. 50% of that is America's debt. If they can increase the money supply to $10 million, well, they went from 50% of the money supply being their debt to now 10% of the money supply being their debt. If they inflate the money supply to $100 million, they've gone from 50% of the money supply being their debt to now 1%. 1% of the money supply being their debt. But I emphasize, in the new model where they can export the debt by bypassing central banks, the SWIFT network, Federal Reserve, all of it, and putting it right into your pocket, my pocket, the Venezuelans' pocket, the Colombians' pocket. They've now inflated away their debt. They've reduced the yield that they're probably going to pay to the stablecoin providers if they even need them at all. And they have now their reach of the dollar in huge demand to the rest of the world. And the final piece of the puzzle is this: because everyone's going to be using the dollar in a digital form way more effectively, and it's got a greater demand, and it becomes a better anchor point, and the Australian peso collapses, and the Venezuela bolivar collapses, and the British pound sterling collapses, and the euros collapses, all fiats are failing. What this will do is it will likely collapse all of these global currencies at a much faster rate that they're already collapsing. And consequently, it will give the US dollar a much greater lifespan. This is why it's called the Genius Act. I'm not saying it's moral. I'm not saying it's fair, but it is absolutely genius. It is an absolutely genius play by the United States government to extend the life of the US dollar, to deflate away their debt, to become the global reserve currency far more dominant than any other currency. And now that is why we are moving into a currency war. There are three competitors in the currency war: the US dollar, BRICS, and Bitcoin. Now, people would say, no, it's gold. It's gold. You can't use gold on the internet. And so, well, I'll tokenize gold. Well, how do you do that? Okay, well, I'm going to centralize gold in a vault, and then I'm going to write a note against it. Congratulations, you're back to the fiat standard. It's going to be double spent. Gold's going to be confiscated. So there's three big competitors now: the US dollar, BRICS, and Bitcoin. And in my prediction, there's going to be a massive battle. It's probably going to go kinetic. There will be hot lead flying through the air, and eventually the outcome will be this: I don't trust you. You don't trust me. We don't trust them. We don't know what the supply of gold is. We can't back it because we always centralize it, double spend it, confiscate it. Let's go with a decentralized, open, neutral, borderless, censorship resistant money that everyone can see. No one has to trust because it's trustless. Everyone knows where it is. Everyone can see what the supply is. Let's go with Bitcoin. That's why Bitcoin will win.
And the point I want to highlight here is this is, as you say, at one level, a genius play, but it's a play that is supporting the US economy and all of those things. In fact, the Genius Act announcement from President Trump said this will actually prioritize consumer protection, strengthen the US dollar's reserves, currency status, and bolster our national security, right? This is about re-cementing the position of the US at the expense of everybody else, right? Because what it is doing is actually doing what they've been doing, but on steroids, to a new game. And so those looking from outside saying, hang on a moment, we can see what you're doing. They're dead right. Now, to my mind, this partly explains the recent rise in gold, because effectively in this scenario where effectively they are exporting inflation effectively through the stablecoin channels, removing the role of the Fed, reducing the role of the Fed, and all of those things. It's highly inflationary. And of course, it increases liquidity. So actually, it doesn't get you. And here's the bottom line. They will never be able to get the debt paid off or reduced. Because if they did that, the whole of the US economy and probably the global economy would collapse. So this is a one-way perpetual motion machine where effectively you have to get bigger and bigger and issue more and more liquidity. So this is the next channel of liquidity that's being created through the stablecoin plays. And I want people to understand what this means, because there are huge implications for every country around the world, those relying on the US dollar directly and indirectly, and those coming to this value anchor issue. We are going to be devalued to bilio as a result.
Mm. Yeah, it's tragic. It's, as I said, it's genius, but it's not moral. But we've seen the play before. Now, again, this isn't. Many people say, "Well, you're having a dig at America." No, it's a dig against humanity. People cannot be trusted. Again, this is why we come back to Bitcoin. You need a trustless money. And I know people love gold, but how much gold is there? How do you verify it? How do you move it? I can move Bitcoin from point A to point B instantly, almost instantly, for almost free. I cannot do that with gold. It doesn't mean gold doesn't have a value. I have gold. I like gold. It looks pretty. It feels heavy. There's a finite supply. I don't know what that supply is, but I like gold. The truth is this, though. Gold will not work as a global currency. It's never worked. I've got 5,000 years of data to show it doesn't work. Oh, yes, it does. No, it doesn't. They clip the ticket, they dilute it, they steal it, they centralize it, they double spend it, and then we start again. So anyone, the shifts of the world, and we talk about Schiff a lot because he's the antithesis to Bitcoin in the sense that he believes it has to be gold. How much gold is there? How much gold will there be? How do I use gold at the shops? His response is, we'll put the gold in a vault and then we write a note against it. That's the dollar. And then eventually they de-link it. And they say, well, no one's collecting their gold and we can just double spend it. And no one can audit the gold. How much gold is in Fort Knox? No one knows. Is the gold in Fort Knox? I don't know. Even when Trump and Musk wanted to get in there, it never actually happened. How much gold is in the world? No one knows. So then we have to say, well, who do we trust? Do we trust America? No, because in 1971, go back to the Bretton Woods Convention and the creature from Jekyll Island. Hey, world, you all give us your gold. We'll write a note against it. And we promise at any time that you can redeem your gold with your note. We promise. We're good for it. Don't worry, we're good. So the whole world gives their gold to the United States. And then in 71, America goes, gotcha. You can't get your gold, but don't worry, this is only temporary. 55 years later, it's still not temporarily pegged to one for one. So America can't be trusted, not because America is bad, but because people can't be trusted. So then you look at brick smart and you say, well, hang on a second. If gold's never worked in the history of humanity as a global reserve currency, and so yes, it did work. No, it didn't. If it worked, we'd still be using it now. We don't use it now for all the reasons I've described. It is centralized, it is diluted, it is clipped, it is centralized, it is double step spent, it is stolen. It never works. It never works. Doesn't mean gold doesn't have a value. It just means it doesn't work as a global reserve currency. And so, well, if America couldn't do it, if the Spanish Empire couldn't do it, the French Empire, the Dutch Empire, the Roman Empire, the Greek Empire, the US Empire, okay, now the BRICS Empire, they can definitely do it. So we couldn't get one empire to do it in the past, ever. It always failed. But this time we can definitely do it with Brazil, Russia, India, China, South Africa, and 30 other nations. That's really going to be auditable. None of them are going to double spend it. None of them are going to confiscate it. None of them are going to be dodgy. We couldn't trust one empire in the history of humanity, but we could definitely trust 30 empires working as one. Humans can't be trusted. We cannot be trusted, which is why we need a trustless money. You don't need to trust Bitcoin. It doesn't need your trust. It's open, it's immutable, it's borderless, it's censorship resistant, it's neutral, it's available to anyone. It's all there. It's set. You can look at it at any time. That is why Bitcoin is the most perfect monetary system we've had in the existence of humanity. Fact. We have never, ever, ever in all of humanity had a money with a known set supply. We have never, ever, ever had a money that could not be confiscated by centralized bodies or diluted by those at the top or double spent. We've never, ever in the history of humanity had a money where the transaction is the verification. We've never had this before. And for many people, we can't grasp this concept because we've never had all these technologies synergizing together. Money is a language. We talk about money in accounting terms, store of value, medium of exchange, unit of account. But it's more than that. It's a store of energy and it's a language. But beyond that, it's also a technology. Many people think money is not a technology. Of course, it's a technology. It's not like God created the earth and he said, on the 13th day, there will be the US dollar and thou shalt use the US dollar. Money is not some type of mythical being from a higher power. And it's not some type of law from the United States overlords that says you will use the US dollar as a global reserve currency. No, money is just simply a technology. And now we have all of these technologies synergizing together in a way that we can drive cars and fly planes and shoot rockets into the earth, out of the earth, and into the earth. Everything has evolved in humanity, everything except money. And you say, no, no, Adam, we can use internet banking. That wasn't an evolution of money. That was a distortion of a broken system where they can make it even harder for you. They can block, seize, monitor your transactions. They can just do it faster and more effectively now. So money has evolved, and people are so resistant to this evolution because they don't understand the evolution of money. Go back to probably when you were a little boy, Martin. I always somehow relate to your age. Can you remember, Martin? This is a legitimate question. Don't worry, we're all friends here. Can you remember life before credit cards and after credit cards?
I can.
Okay, so I really want you to get present here. When someone came to you and said, don't worry about cash. This isn't a credit card, it's a business card. We want you to use this piece of plastic here. What was your reaction or your mum's reaction or your parents' reaction or civilization's reaction when you said, you don't need cash, you don't need gold, you're going to use this plastic, it's going to be on a machine and they're going to go clink, clink. What did people say?
Well, my father was a bank manager. And so he was actually right there he brought home the first machine readable card that you could put the card in the machine. It would give you $10. The card would be kept by the machine, and then they would send you the card back through the post, and then you could use it.
Wow.
Right. That was right at the beginning of, machine in the wall, right?
Before the machine would take your card.
Correct. It would be a plastic punch card. You put it in the machine and it would eat the card. It would give you $10, and then they'd send you back the card through the through the post, right? So that was the first wave of digitalization, right? And by the way, they had the very first computers. They put what were called B90 computers in, which was all talking to a mainframe, right? A massive database. And they had to put all the transactions in for the first time. So that was the first wave. The second wave then was the credit card thing, right? And my father said, this is not good, because what this is doing is it's going to actually make people more willing to take debt. The consciousness of the value of money will be reduced. And he actually refused to allow us to use credit cards for years and years and years because he believed it was the slippery slope. Now, I think he's actually largely right, actually. And so the whole concept of moving away from physical money and physical transactions was something that he was there right at the start of it. Now, I came along, and I was growing up in that period of time. So I saw the evolution. And I remember the first time when I was a student, I got a credit card for the first time. And boy, I suddenly thought, wow, I can go and spend. No, hang on. So for the first little while, I actually overspent. And then I ended up with debt that I had to deal with. And so the problem is we disassociate that plastic from the real value of money, right? And what it means is that it changes our relationship with how we actually obtain things and what the reward mechanism is. That's the fundamental philosophical issue that we're dealing with here, right? And it's going on, right? It's going on and on.
That's an awesome story, but allow me to challenge you a little bit there. Think of money, store of value, medium of exchange, unit of account. What actually changed there? Did the store of value change? No. Did the unit of account change? No. What changed? The medium of exchange. So money didn't change in those aspects. The store of value was the same, the unit of account was the same, but the medium of exchange changed. So instead of taking cash or a check, you use this piece of plastic. Bitcoin takes it a step further. What changes in Bitcoin is the store of value. The store of value is a set supply. So this is where we're like, oh, right, in all this evolution of money, what was really changing was not the unit of account, it was still a dollar. Or maybe it was threepence and shillings back in your days. I'm not suggesting you're that old.
It was
the, it
pre-decimalization.
was.
It
There you
was.
go. So the in your life, the unit of account has changed. The medium of exchange has changed. But until now, my friend, what hasn't changed is the store of value. That's the biggest difference in Bitcoin. The store of value is the set supply. Whereas you can throw anything you want onto digitizing gold and putting a banknote against it, or check notes, or digital coins against it. It doesn't change I would argue, the most important part of money. The most important part of money is the store of value. Because if you don't have that store of value, the reality is it's a deflationary asset. Now you might say, well, hang on, again, gold's going up in price. Gold is not, in fact, to the extent gold is not increasing your purchasing power. The numbers are going up on the screen, but it's not increasing your purchasing power. I've interviewed Jeff Booth, and I've said this before, and I'm going to reference Jeff Booth. The natural state of a free market is deflationary. What does that mean? The natural state of a free market means that prices get cheaper. Why? Because technology gets better. Things become more efficient, production lines move more smoothly, transport is more efficient, everything becomes better. So as things get better and more efficient, the natural state of a free market is prices go down. But because prices don't go down in our market, everything's going up. There's a few exceptions, like TVs over time. You think about a big screen TV, they've gone down relative, a huge flat LCD screen years ago was a stupid amount of money. Now, of course, you can still buy a huge LCD screen now, but you can get a cheap version and a really expensive version. But beyond TVs, everything else is going up around us. Why? Because we're not in a free market. And the reason why we're not in a free market is because money is broken. And the reason why money is broken is because money has been corrupted by those at the top. And the reason why those at the top are allowed to corrupt money is because they've denied you an education about money. And people are financially illiterate, not because they're bad, not because they're stupid, but because they've been denied an education. If people understood what money was, store of value, medium of exchange, unit of account, if they understand the store of value, they would understand, oh, hang on a second. The store of value is corrupt because they keep printing it. The problem with gold is that, hey, it might be a better store of value than a dollar, but how do I use it as a medium of exchange? Money is a store of value, medium of exchange, unit of account. How do I use gold as a medium of exchange? I can't use it at the shop. I can't use it online. I can't use it with my friends. So gold doesn't have the three parts of what money does, and what money needs. Money needs all three parts. Bitcoin has all three parts. Now, I can already hear, I don't even need to look at the screen. You can't spend Bitcoin anywhere. That is a blatant lie. I use Bitcoin at Woolworths, at the post office, at the service station. Why? Because it's linked to my credit card. I have the medium of exchange with a credit card or a QR code. I have multiple, and I can even do it peer to peer. Bitcoin has multiple mediums of exchange. The unit of account is a Satoshi. And you said, but no one knows that. Doesn't matter. A unit of account, I can translate it just as I can translate a British pound sterling to a Australian dollar to a Indian rupee, you can easily translate a unit of account easily straight away to any other currency in the world. So that one cancels itself out. But when it comes to a store of value, Bitcoin is the most superior store of value out of the dollar, out of gold, out of Bitcoin, and I can prove it. My purchasing power in Bitcoin continues to go up. Your purchasing power in the dollar continues to go down, and your purchasing power in gold remains consistent. Now, again, this might trigger some people and say, no, 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 the price of Bitcoin gold went up. Your purchasing power didn't go up. The number on the screen went up. So when you actually say, hang on a second, gold, gold lacks two of the three. The dollar lacks the most important one. It's not a store of value because it keeps being deflated. And even though they keep adding these layers on top, the store of value is still completely screwed because they keep inflating away the supply of it. You then say, well, hang on, Bitcoin's got all three of it. Bitcoin is a medium of exchange because I can use it anywhere with anyone at any time, blip straight away because we're already using digital. I can store it easily without a bank, without permission, without anyone inflating it, without anyone confiscating it. It goes up in purchasing power. And it's a unit of account because it's digital, so I can break it into smaller pieces. And if people don't know what a Satoshi or a Bitcoin is, no worries. I can convert that. I can translate that to different languages. Just like think of any language. As I said, money is a language. If I want to say hello in English, it's hello. In Spanish, it's hola. In Italian, it's ciao. In Chinese, it's ni hao. My point is, I can just simply translate as a language whatever the unit of account is. Once you break this down, you're like, oh yeah, Bitcoin makes sense. Bitcoin is money, store of value, medium of exchange, unit of account. For all of the reasons I've just described and a hell of a lot more. The most important reason is I don't need to worry about any government, left or right, or any bank, bloody banks, coming in here and confiscating and diluting it. It's completely mine. I am in control. It is the essence of democracy.
Well, that's an interesting way to finish, Adam. Thank you so much, as always. Very, very interesting discussion. I can say that you've melted down the chat this evening, as normal, but that's great.
I
If
didn't
people,
even look.
no, fair enough. If people want to find out more about you, where's the best place for them to go?
Well, again, thank you for having me tonight. And I tell all the viewers here, like, I'm not telling you how to think. I'm just asking you to think, to challenge everything, challenge what I think, what you think, what the mainstream media thinks. If you want to join me, everyone's welcome on my channel, Adam Stokes. Come on over. Everyone's welcome there. We do a live show every Sunday and Wednesday. Debate is welcome. Insults and abuse will not be tolerated. Buy my book, 28 Pro Trader Tips, The Art of Trading. Follow me on X on Adam_Stokesy. Or if you want to do anything crypto safely, if you're not sure, you just want to dabble into the markets or buy a little bit of crypto, remember you only need 1 cent. You don't need to buy a whole Bitcoin. You can buy $1 worth or 1 cent's worth. Head over to thecrypto.land, www.thecrypto.land, where you can do everything crypto safely on one simple and secure site.
Thank you, sir. As always, really appreciate it. And I'll look forward to picking up the conversation with you down the track. I'm sure these things are going to continue to evolve, but there are some really, really important concepts that we've touched on tonight, folks. And I want to say thank you for all of those in the chat and all the comments and everything else. I'm going to take you offline now, Adam, and I'm just going to close the show. See you later.
Cheers, man.
So there you go. I hope you enjoyed that. As I say, very, very important concepts that we've touched on tonight. So go and play it again if you've missed some of it. There's a lot to go through there. Just say that next week there's going to be a show specifically looking at first-time buyers and how they're reacting to the government's recent interventions in the market. I've got some data, and also we're going to look at some specific case studies, so that should be quite fun. The doggies are still here. They didn't bark because I haven't done my delivery yet, so that's good. And everything's looking fine. So thank you very much. Have a very nice Tuesday evening. Please like and subscribe if you haven't done so. It always really helps us to get the algorithm to work. And check out our live shows every Tuesday evening. I put up a daily show as well on recorded mode, and there'll be a new show tomorrow as well. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Take care.